Scope and boundaries in carbon accounting. Now, as I've said before, carbon accounting is a vital component of environmental management and sustainability efforts, providing organizations and individuals with the means to quantify and track their carbon emissions. The process involves measuring and reporting the carbon footprint, which encompasses both direct and indirect emissions. To effectively implement carbon accounting, it is essential to define the scope and boundaries of the assessment. This video delves into the intricate world of carbon accounting, exploring its scope and boundaries and emphasizing their significance in understanding and mitigating climate change. Understanding carbon accounting is a subset of environmental accounting that focuses specifically on tracking and managing carbon emissions. It involves a systematic approach to measuring and reporting greenhouse gas emissions with the ultimate goal of reducing them. The primary greenhouse gas of concern is carbon dioxide. There's also methane and nitrous oxygen, among others. Accurate carbon accounting allows entities to understand their emission profile, make informed decisions for mitigation, and demonstrate commitment to suitable practices. The scope of carbon accounting refers to the extent to which an entity measures and reports its greenhouse gas emissions. It typically encompasses three distinct scopes, as defined by the Greenhouse Gas Protocol. First of all, there's Scope 1. These are direct emissions, generally from sources that are owned or controlled by the reporting entity. These emissions include those produced by combustion of fuels on site, such as the use of natural gas for heating or company-owned vehicle fleets. Then there's Scope 2. These are indirect emissions associated with the consumption of purchased electricity, heat, and steam. They result from activities outside the organization boundaries, but are essential for the organization operations. Finally, there's Scope 3. These are indirect emissions. They encompass all other indirect emissions that occur as a result of an organization activities, but are not directly owned or controlled by the organization. These emissions are often the most extensive and complex to measure, involving a wide range of sources like supply chain activities, employee commuting, and business travel. The decision to include Scope 3 emissions in carbon accounting can significantly expand the scope of the assessment and provide a more comprehensive view of the total organization's environmental impact. However, this expanded scope also presents challenges in terms of data collection and boundaries. Now, setting boundaries in carbon accounting are the limits or constraints within which carbon accounting is performed. Establishing boundaries is a critical aspect of the process, as it defines what emissions are included or excluded from the assessment. The boundaries are determined based on the following consideration. First of all, there are operational boundaries. This refers to the organization's physical or operational limits. These are the boundaries within which an organization has direct control or influence over emissions. Determining the operational boundaries is relatively straightforward for Scope 1 emissions, as they are directly associated with on-site activities. However, for Scope 2 and Scope 3 emissions, operational boundaries can be more complex, especially when considering supply chains and long-distance commuting. Now, there are organizational boundaries. These boundaries are broader than operational boundaries and encompass the entire organization with all its entities, subsidiaries, and facilities. In some cases, organizations may choose to consolidate emissions from multiple entities, while in other cases, the focus may be on individual entities or facilities. This decision depends on various factors, including the organizational structure and regulatory requirements. There are financial control boundaries. These boundaries are used to include emissions from entities in which the reporting organization has financial control, even if they are not fully consolidated in the organization's financial statements. This approach ensures a more comprehensive assessment of emissions, but can be administratively challenging, especially for large multinational corporations. Equity share boundaries. Equity share boundaries are relevant when an organization owns a significant share of another entity but does not have full financial control. In such cases, a portion of the emissions may be reported based on the percentage of equity owned in that company. Next, there is geographical boundaries to consider. The location of the emission sources. For multinational organizations, determining whether emissions from international operations should be included can be very complex. Different countries may have varying reporting requirements and emission factors. There's also time boundaries to be considered. These time boundaries establish the time frame for which emissions are measured and reported. Common reported periods include the annual, quarterly, or project-specific durations. The choice of reporting periods can impact the accuracy of emission data, and it is essential to be consistent in setting time boundaries. Now, the significance of scope and boundaries of carbon accounting play a pivotal role in the effectiveness and relevance of emission assessments. Here are some key reasons why they are most significant. Comprehensive assessment. Determining the scope of carbon accounting ensures that an organization or individual is not only aware of their direct emissions, but also considers indirect emissions. This holistic view is crucial for a comprehensive understanding of the carbon footprint. Transparency. Defining clear boundaries in carbon accounting allows for transparency and reporting. Stakeholders, including investors and customers and regulatory bodies, can gain insights into an organization's effort to track and manage emissions. Performance evaluation. With well-defined scope and boundaries, organizations can evaluate their performance and set meaningful reduction targets. This supports the transition to sustainable practices and can enhance an organization's reputation. Mitigation strategies. Scope and boundaries help organizations identify emission sources and their relative contribution to the overall carbon footprint. This information is invaluable for devising effective mitigation strategies which can lead to substantial reductions in emissions. Regulatory compliance. Different regions and jurisdictions may have specific requirements regarding carbon reporting. Now let's talk about defining the scope and boundaries in line with these requirements ensures regulatory compliance and minimizes the risk of penalties. There's a risk assessment. A clear understanding of scope and boundaries enables an organization to assess risks associated with carbon emission. This includes potential supply chain disruptions, increased costs due to carbon pricing mechanism, and reputational risks. Benchmarking. Organizations can compare their emission performance with industry peers when there is consistency in defining the scope and boundary. Benchmarking allows for competitive analysis and opportunities for improvement. Challenges now in defining the boundaries. While the benefits of setting clear boundaries in carbon accounting are evident, there are challenges associated with this process. One, data availability. Collecting data on emissions, especially Scope 3 emissions, can be challenging. It often relies on the cooperation of external entities, such as suppliers, which may not have consistent reporting practices. The quality of data. Ensure that the quality and accuracy of emission data is essential. Incomplete or inaccurate data can result in misleading assessment and poor decision making. Data aggregation. Aggregating data from multiple sources, particularly for organizations with complex supply chain, can be labor intensive and time consuming. Scope 3 inclusion. Deciding which Scope 3 emissions to include is often a matter of judgment as well as strategy. Some entities may choose to report comprehensively, while others may focus on a more narrow set of categories. There are cross-border challenges. Multinational organizations must navigate varying reporting requirements and methodologies across many different countries and regions, which can complicate the process. The idea of equity share and financial control. Determining the level of financial control or the share of equity that a company has in a subsidiary requires to include emissions from associated can be a subjective decision. In conclusion, scope and boundaries are fundamental concepts in carbon accounting, shaping the extent and accuracy of emission assessments. Defining the scope allows organizations and individuals to understand the extent of their carbon footprint, while setting boundaries determines what is included or excluded from the assessment. Clear scope and boundaries are essential for transparency, for performance evaluation, for regulatory compliance, and for risk assessment. However, they also come with challenges related to data availability, the quality of data, and strategy. In the face of climate change, effective carbon accounting with well-defined scope and boundaries is an indispensable tool for tracking and managing emissions. As stakeholders continue to demand greater transparency and sustainability efforts, the role of carbon accounting in promoting environmentally responsible practices is more crucial now than it ever was. By embracing these challenges and refining methodologies, organizations and individuals can contribute significantly to a more sustainable, climate resilient future.